Looking at the Treasury market today, I was just saying we're not seeing much change, which is perhaps surprising given what happened with the jobs report. Why do you think that is?
Well, I think for one important reason that the Treasury market is priced for perfection almost at these levels. That, it's not just a slowing economic recovery. It's almost we're beginning to price in more of a chance of a double dip, more of deflation. And that's sort of been the way the Treasury market's been this year. It's been black or white. It's V-shaped recovery, inflation to begin the year. Now it's deflation and double dip. And I think there's something looming ahead that's in the middle, something more in a shade of gray.
So you don't think that yields on Treasuries should be as low as they are right now?
No, I think there's some other underpinnings. I think if things in Europe continue to sort of calm down, there are a couple of big events coming up, the release of the European bank stress test, Spain has to refund itself. If we get no more hiccups from overseas and we see more of this mixed economic recovery here, then the underpinnings for these lower rates will begin to go away, and I think they're going to rise later this year.
So are you recommending that clients sell Treasuries right now?
At these levels, more so at the back end of the curve. That's where I think more of the vulnerability is. Obviously, the Fed's in no position to raise rates anytime soon, maybe by spring of next year. So the front end will be a relative outperformer. It's the back end I'm more concerned about.
And the flattening of the yield curve that we've been seeing, is that basically just a reflection of this same overly pessimistic sentiment, do you think?
Absolutely. It's that deflationary argument that there is no concern whatsoever about inflation rearing its ugly head anytime soon. And I would agree. I don't think you're going to have major inflation, nor do I think you're going deflation as well. But I think, to me, a better fair value is to retrace where we were. And that brings you back on the 10-year to about 3.75% to 4%.
I'm curious, though. I mean, when you look at the jobs report today, and we've been talking about these numbers of how long it's going to take to get back to full employment, I imagine there's probably an upper end you're looking at on yields as well. I mean, it's not like we're going to see a big bump up there.
No, not at all. And I think that's what's important about this recovery process. Jobs are going to lag. It's going to take a while before we get any new hiring of meaningful consequence. So I think when you look at it in that format, 3 to 4%, the range on the 10-year Treasury over the next, say, 12 months is probably your more likely scenario. It's just I think we're too low right now.
Kevin, I'm curious, besides maybe telling people to take a little bit off the back end, what about risk? Are you recommending that clients take on a little bit more risk here?
Well, yeah, it's sort of like that movie, What About Bob? It's sort of baby steps right now. And I think when you're looking to put any risk back on, I would start first in investment-grade corporates. I think that would be my first foray to start taking some risk trades back on. And perhaps later in the year, if we're right and things do shift somewhat, then maybe you can start looking at high yield and maybe some emerging market as well.
Are we seeing any of that sort of start to happen? Any interest and appetite from investors to do that kind of thing already?
Interesting, not so much with investment grade or emerging markets, but we have seen high yield spreads come in. There has been some interest in the widening in gaps that we've seen there. So it's a slow process, but there is beginning to get to see some nibbling, shall we say.